I hope that the explanations that I gave in the first part of today's session give you a somewhat better understanding of the mechanisms that are described at length in the textbook, and that I will sketch a little bit more in the next two parts today. And these of course concern the international monetary system and the international financial system. So what is the international monetary system? The international monetary system does to the international economy what the national monetary system does to the national economy, namely providing money that can be used to perform economic interaction, so purchases, sales, imports, exports, investments, and so on. All of these require money, and it's quite easy to think that if you want to buy something from another country, if you want to invest something in another country where there is another currency, then you will depend on some system in which you can exchange the money that you have, that is in the currency of your country, for the currency of the other country, and then buy the stuff. Without that, there would hardly be any international economy to speak of. So the international economy can only work if there is such an international monetary system, or short IMS, and this must regulate the ways in which currencies are exchanged. And you can say that there are three issues that all international monetary systems must address in one way or the other. And this is also described in the textbook, but not in the current chapter, but in an earlier chapter, I think in chapter 4 probably. So first you have to define the role of exchange rates, which mainly means, are they fixed or do they float against one another? So the question is, will that €1 that I have in my pocket right now, which is worth such and such dollars, will the amount of dollars that I get per euro change over time, or will it be fixed for the time being? We have fixed currency exchange system where this doesn't change, and this of course has the advantage of a certain stability in economic interaction. However, it also has disadvantages. I'm going to talk about this later, in the sense that it makes it very difficult for the countries to make independent policies, because they have to make policies in order to support this fixed exchange rate. Second, it is important that the nature of the reserve assets is defined. And this is, when you think about it, if you have a lot of euros and you want a lot of dollars, then there has to be some system where you give your euros back to the central bank that issues the euros, which is the European Central Bank, and then get dollars from the Fed in the United States. And there has to be some system for that, which means that all the central banks have to hold some kind of reserve asset that they will promise that they will give you if you give the currency that they issue back. And this was gold for quite some time, and then it was changed rather to foreign currencies, so that all central banks have reserves of different currencies, mostly dollars. And if you go to the European Central Bank, and if you are a bank yourself and you say, well, I have 10 million euros here, please give me dollars for that, then they promise that they are able to do that, and that they have the reserve. In Europe it's technically a little bit different, but that's the general idea. And finally, you always also have to address the control over capital movements, because if capital moves across borders, that means basically that large amounts of money will flow across borders, and this can put pressure on certain currencies. So if a lot of capital flows out of one country into another country, which is what happened at the beginning of the coronavirus crisis, when a lot of investors withdraw their investments from emerging markets, this means that a lot of money flowed out of these emerging markets, which means that the investors, they sold the currency of these markets that they held and then exchanged them for dollars. And this puts pressure on the value of the currency, which is sold at such a high rate, and puts pressure on it to devaluate or to depreciate. And in order to control this, the system might be based on some capital controls, which means that not all investors can take their money across borders as they will. And in some countries, if you are there as a tourist, you might even find that they forbid you to take even small amounts of their money out of the country, because they want currency to flow into the country, but they don't want it to flow out of the country. So this is on a very small scale, but you can think of it also on a much bigger scale, that countries will control the capital movements. And in order to understand why these international currency systems, monetary systems are systems, it's important to understand the mechanisms by which the different national economies are connected. So the mechanisms that work as transmitters between these economies. And one thing that you can look at to understand this is the balance of payment, which is also mentioned in the textbook. And the balance of payment consists of, depending on the definition where you look at, 2, 3, 4 separate balances. I took a version here where 3 parts are distinguished. So the first part of the balance of payment is the current account. And it's called current account because here immediate short flows of money that happen this year and that don't necessarily have any effect for what happens next year are recorded. And there are a number of ways in which money flows for short term. The first is exports and imports. So if a country exports some commodities, it will have to be paid by the other country with money, and vice versa. So for every car that ships around the globe, for every piece of copper or coal or whatever commodity is traded, some money will have to go the other way around. So this is why exports count as a positive sign. So when you export something, you get money for it, so there is a credit booked in your name. If you buy something, if you import stuff, then there is a negative. Something else in the current account are incoming transfer payments. These are, for example, payments that maybe migrants pay to their families in their home country. So if a migrant from, let's say, Guatemala goes to the United States, somehow manages to get in and gets some labor or some working contract there, and then works on a farm or in a household or wherever, they typically send some part of the money that they earn back to Guatemala. And this, of course, then is a transfer payment. And if you look at this individually, it's not a lot of money, but if you look at the sum total, it's very important for these economies, and this is something that's booked as a positive in the accounts of the countries where the money is received. Something similar goes for earnings on foreign investment. So let's say there is a German bank or German firm or fund that invested a couple of $1 million in the United States, and now they get maybe 100,000 euros or dollars per year back as return on their investment. Then this flow of return on investment is also counted in the current account, and again it's a plus in the country that receives the money. And once again, we're back at the equalities that I described at the beginning of today's session, because for every plus that's there in one country, there is going to be a minus in another country. So whenever some amount of money is paid from the United States to Guatemala as transfer payment, then it's always a minus in the United States and an equal plus in Guatemala. When it's paid for some import that the United States gets from China, it's a minus in the United States and a plus in China. And when it's paid for some foreign investment that the profits will flow out, then it's a plus in the country where the investor sits and where the money is paid to, and it's a minus in the country where the money is invested and where now the profits flow out. And this is the current account, and because there's always a plus or a minus, globally it will always be zero. And if you look at the data, you always find something that's not zero. So if you look at the total trade balance of all countries, there will always be some measure beyond zero, but this is only because there might be errors and omissions, and maybe the countries calculate this differently, but this is only a problem of measurement and calculation. In principle, the current account globally will always be zero. However, one country can have a current account surplus or deficit. So Germany is a country which, for most of the time after World War II, they had a current account surplus. So they export more goods and services than they import. This is the main driver here. While the United States has become, in the last decades, a country with large current account deficit, and there are also other countries which have deficits and surpluses, but these are the one with the biggest ones if you look at it globally. If you look at it you can also look at it in pairs, then it is the case that the United States also have a very big current account deficit with China. If you look at the second point in the balance of payment, you look at the capital account. And the difference between capital account and current account is that current account records money flows that just happened this year and that don't have much implication for next year. Capital accounts, however, they record money flows that go from one country to another, but with the expectation that there's some demands that will be relevant next year. And typically you have two main drivers here. One is borrowing and lending. So we have loans. So if you give credit to someone in another country, which is also part then of foreign indirect investment that I talked about 2 weeks ago. This is part of the capital account, and this is in the capital account and not in the current account, because if you lend money to someone in another country, you expect them to repay you, and you also expect them to repay you with interest in the coming years. So this is not just a current transfer payment, but it's something that comes with liabilities and with duties over the next couple of years. Something similar is true for foreign direct investment. So again, if a German company buys a company in, I don't know, Malaysia, or sets up a new factory in Malaysia, then it means that money will be transferred from Germany to Malaysia, but once again with the expectation that over the next couple of years profits will flow back to Germany from Malaysia. So this is the capital account, and you could also name some other things. And once again, you see that for every dollar of capital that will flow from one country to another as an outflow, there will be an inflow in the other country. So every outflow also is an inflow somewhere else. So once again, the global sum of all of which happens here is once again zero. And what you see between current account and capital account is that the two typically could be expected to add up to something that is already near zero. So countries that have a big current account deficit, so they import more than they export, therefore they pay more money for their imports than they get for their exports. These countries typically have a large capital account surplus, which means that they have to borrow money from somewhere else to finance their consumption, or there is a lot of investment flowing into the country. And depending on the kind of money that's flowing in different directions, this might be more or less sustainable. So if you are a country that over many years consumes much more than it produces, or that imports much more than it exports, and this is only be equalized by a lot of loans flowing into your country. That means that you amass a lot of debt in the country, and this is probably not sustainable in the long run. If, however, it's paid for foreign direct investment and it's equalized by foreign direct investment that comes to the country that will stimulate the economy here, the story might be somewhat different. However, if we just take these things that I just mentioned, it does not always add up to zero for one country. Here we have to add a third point, and sometimes this is seen as part of the second point, sometimes it's divided in different way, but here it helps to take out the third point as an individual, and this is the official settlement account, and this refers to the reserves of the central banks. So if a country has a deficit under 1 and 2 together, then this means that more money flows out of the country than flows back into the country. And this typically means that the central bank in the country with this deficit, that they have to deal with the fact that a lot of people want to get rid of their country. So let's say that the United States has a big deficit under 1 and 2. That means that a lot of people want to either get dollars out of the United States or get rid of their dollars. And it's a special thing with the United States. So this was probably not the best example, but let's say it's the United Kingdom and you have the pound sterling and then the British Central Bank, then they might be forced to live with the fact that a lot of people want to get rid of their pound sterling because they don't need it, because the money flows out of the country and you don't need pound sterling anywhere else than in the United Kingdom. So they want to exchange it for dollars, which means that the central bank in London, that they have to buy back the pound sterling and give out typically dollars or maybe euros to do so. And this means that their total reserve of other currencies or their reserve of gold shrinks. And the opposite, of course, is true if it happens the other way around. And if you have a deficit under 1 and 2 and this happens, this typically affects the exchange value or the exchange rate of your currency if your government does not do something about it. And once again, if you look at these kind of activities globally, it will also add up to zero. And another thing, it's important here, if you don't look at the lines but also at the columns, then you will also see that if you take all three things combined, then for each individual single country, the balance of payment, if you take all these things, will always also be zero. So if you export more than you import, and there's also a net inflow of capital, that means you have a plus under 1 and 2, then there has to be an equal minus under 3. It cannot be otherwise, it will always be that way. So the total sum of all three numbers here will always be 0 for each individual country, and it cannot be otherwise. Yet now you might be confused, why is there so much talk of a balance of payment deficit, and you also find the expression balance of payment deficit in the book. And sometimes there's confusion, sometimes the balance of payment deficit is equalized to a current account deficit, which is not the same thing. However, the technical definition of a balance of payment deficit is that you have a deficit with the combination of 1 and 2, and that has to be then equalized under 3, which means that the central bank has to do something with their reserve, and if this happens, then you can speak of a balance of payment deficit, or if you have a plus under the combination of 1 and 2, then you can speak of a balance of payment surplus. And you might argue that this does not make sense and that this is a stupid definition to speak of a surplus or a deficit when something will always be zero, and to define something sometimes inside it, sometimes out it. I cannot argue with you here, but that's the definition that's established, and I cannot change it. So what is happening if there is a deficit? And it's typically always already starts with the current account deficit for most countries, not for the United States necessarily. If you have a big deficit in the current account, and if you have a deficit in 1 and 2 combined, then the state has to become active somehow. So they either have to raise competitiveness of the product in the country, which means they have to make sure that better, more innovative products are produced in their country, which is of course the best thing that you would always expect. However, it's also the hardest thing, because you can hardly just demand this as a state. It's a long-term process, which typically means investing in education and infrastructure now, and then it will pay off in the long run. So it's not so easy to make the products in one country better politically in the short run. What you can do in the short run, or in the short-term run, is that you try to deflate your economy. So if the problem is that your people consume too many products from outside the country, from the rest of the world, then the solution might be, well, if the people have less money, then they consume less stuff from other countries. So you try to make sure that people in your country have less money. So you want lower wages, you want fewer jobs, and therefore you want less consumption of stuff that's outside. You can also, of course, try controlling the stuff that's coming in. And this is something that kind of works, and this works almost automatically if you are under the gold standard. However, this is obviously not something that's very desirable for a government to artificially and consciously deflate their economy. Therefore, there might be the solution under number 3, which means you try to depreciate your currency, which means to devalue your currency. So you make sure that if you are, let's say, Great Britain, and your problem is that your citizens import too much stuff from Europe and you don't export too much to Europe, then you devalue the pound vis-a-vis the euro, which means that products from Great Britain become cheaper in the European Union, and products from the European Union become more expensive in the United Kingdom, which is not good for the consumers in the United Kingdom. However, it might change the trade balance, and in the long run it might be better for the economy there, at least for the export sectors. So what the point of all this is that the economies of countries are connected, and the stuff that happens economically in one country will have effects for the other country, and there will always be some disbalances between the countries, and this can cause problems and can force individual countries to react to these disbalances. And this is also the base of this impossible trinity based on the model of Mundell and Fleming that's also mentioned in the textbook. So this impossible trinity means that you have 3 goals that are all highly desirable to reach, or that you can consider desirable. However, you can only achieve 2 of these goals at the one time, or if you are certain that you want one of these 3 goals, then you have to face a trade-off between the 2 other goals. So one thing you might want to achieve on the top here is the open capital account, and the capital account means that or is open when as much capital can flow out of and into the country as investors deem desirable, and you as a country don't meddle with this. And this can be desirable because it means that you have a bigger chance of investment flowing into your country, and particularly if you are a developing nation, then that's something that you want, but not only developing countries want that. Also, it's also of course good for investors from your country, because then they might be able to invest their money or their capital where it is most profitable abroad. So this, you could argue, is a good thing. The second thing that's also probably desirable is to have stable exchange rates. I also already explained this. You don't want exchange rates to change too quickly, so you don't want your value to appreciate or depreciate twofold vis-a-vis another currency in a couple of months, because this would make international trade and international investment very, very complicated and very, very risky and very speculative, and that's something you don't want. So you want stability there, and the strongest version of stability, of course, is a fixed exchange rate. When you say €1 will always be $1.10, whatever there may be, this will always be the case. So you fix the two currencies towards one another. And the third thing is that you have an independent monetary policy, which means what I explained before, that you raise and lower the interest rates and perform public investment in your country when you think it's good for your country, for the inflation rate within your country, and for economic growth within your country, according to your domestic needs that you have in the country. And the problem that some scholars have pointed at, based on the model by Mundell and Fleming, is that all three goals might be deemed desirable, however, you cannot reach all three of them. And I just briefly sketched this with the use of 4 different international monetary systems that have been there over the course of the 20th century and sometime before and after that. So first we had the gold standard, which was mainly driven by the British Empire, and it was in place from the 19th century to World War I, basically, so not all of the 19th century, but much of it. And in the gold standard, the idea is that each country will peg their currency to gold. So you will say that if you were on the gold standard, that maybe 1 ounce of gold is €30 and 1 ounce of gold is also $35, and this means that there is some fix for the exchange rate between dollars and euros. It might vary on certain markets at certain times. However, in the end, you will know, well, I'll get the same amount of get this and this amount of gold here. It will always stay the same. I get that and that amount of gold there. It will always be the same. So whenever there will be a disbalance, it will automatically switch back to this relation of the gold prices of these currencies. And this means that investors that want to move beyond borders, they have nothing to fear. The exchange rates will be stable, and also that governments can just allow international investment to flow quite freely, and this is also what a lot of governments for a lot of this time did. However, it means that you are hardly able to do independent monetary and fiscal policy, because it will be determined by the gold prices or by the international markets. So this is also explained in the textbook. I think it's somewhere on page 68, 69, where they make this case for an imaginary scenario between France and Britain. So if there is an export surplus, it almost automatically means that there will be some deflationary effect in the country where there's the deficit, and some inflationary effect in the country where there's a surplus. And so this will equalize itself then, and you drop back to the old exchange rate. However, it means that you as a country are not very well able to manage your economy freely and to manage interest rates and so on, because this is fixed to the dollar. And this means that the gold standard is almost always undemocratic, because it means that monetary policy just happens, or there is almost no such thing as monetary policy in the hands of the state. So the gold standard was given up in World War I, and then it was briefly reinstated in the 1920s, and it did not work for quite the reason that I just explained. And then in the 1930s, there was a regime of floating exchange rates. So the exchange rates between the different currencies was determined by market forces, and this allowed countries to have autonomous economic and fiscal policy. However, at this time, most countries used this to engage in some kind of competitive devaluation. So they all tried to make exports from their country as cheap as possible, and this had negative effects on the international economy because no country was willing to be the importer of all these goods. Everyone wanted to be an exporter, and this kind of competitive devaluation did not work for the whole system. And so in theory, the countries would have been able to allow for international capital mobility. However, there were quite a lot international capital controls in the 1930s. So the lesson from this, of course, is that achieving 2 of the 3 goals is a maximum, but it doesn't mean you always have to do 2 of them. You can always also decide for only 1 of them and not for 2. And this is what happens basically in the 1930s. After World War II, and this is described at length in today's reading in the textbook, we have the Bretton Woods system. And what the Bretton Woods system achieved was basically having stable exchange rates. So it was not the gold standard, it was rather some sort of dollar standard. So the dollar was pegged to the gold, and all other currencies were pegged to the dollars, at least in Western Europe. And this means there was stability, and there were some regulations under which currency could devaluate or appreciate. However, this was strongly regulated, so there was some reliability there when it comes to exchange rates. Also, it was a regime under which individual countries could engage in autonomous monetary policy, and this was achieved by a certain degree of international capital mobility. So there was a lot of transnational investment, but it did not happen freely and unlimited. So this was a Bretton Woods system, and this came under pressure because of what we call the trilemma, which is also described in the textbooks. And some scholars argue that it was just not sustainable, and the Bretton Woods system was bound to come down because this kind of system cannot work. Others argue it was just not conceived in the best way, and make the case, well, in the Bretton Woods summit we had this plan by White and we had the plan by Keynes, and if only we realized Keynes's plan, then the system might have worked, and then it would not be based on the dollar but on the banker, so on some currency that's not that of one country. And yet others argue, well, the Bretton Woods system as it was could have worked, was it not for the so-called euro-dollar market, which means nothing about the euro as a currency. It did not exist back then. It means that there were markets in which dollars were traded outside the legislation of the United States, which was some way also to work around certain measures of capital control and currency control. And this is why, one of these reasons probably is why the Bretton Woods system did not work for much more than 20-25 years. And what emerged after that, when in the 70s the Bretton Woods system was given up, is what we call the Washington Consensus, or the Dollar Wall Street regime, which is based once again on floating exchange rates. So currencies can be traded and can float against one another as the market forces wanted. It also means that we have capital mobility without much limit and without many capital controls. However, because we have decided against a stable exchange rate, it could mean that we have autonomous economic, fiscal and monetary policy, which is kind of the case, but because this whole system is based on international capital mobility, there has to be made a trade-off between the stable exchange rates and the autonomous policy. So in principle, the exchange rates can fluctuate. However, individual countries have good reasons for their exchange rates not to change too quickly and too abruptly. So they have to engage in certain policies to make these shifts and changes bearable for international economic activities, which then again also limits their autonomy in economic, fiscal and monetary policy, because they always have to listen to the international financial markets and see what's reasonable to them. So it's not perfect autonomy. So the dollar walls regime is focused on a yes concerning international capital mobility, and then has to make a trade-off between the other two, with a tendency towards saying in principle yes to the autonomous policy, but in fact you always have to make a trade-off. So then if we look at the triangle once again, then we see that a gold standard realized stable exchange rates and an open capital account, but sacrificed independent monetary policy. The Bretton Woods system, or the Bretton Woods Compromise, connected a stable exchange rate and independent monetary policy at the price of having capital controls. And the Washington Consensus, it allows for an open capital account and then has in principle independent monetary policy, but individual governments always have to make a trade-off in order to keep their exchange rates at a certain control. Last thing I say about monetary system is what we call Rodrik's trilemma. It's also this kind of trilemma where you have three goals that you might want to achieve, of which you can only achieve two, and it's kind of connected to the Mundell-Fleming trilemma. However, it's not the same thing, and it's more political, if you want. So Rodrik argues that there are three goals that many people find desirable, which is deep economic integration, which means that we have global markets on goods and services, on capital, on and rather free migration, and we have global financial markets. So we have a deep integration, and we have transnational corporations, which means economies are not separated national entities that have some small connections, but that they are intertwined on many levels. Secondly, there is such a thing as national sovereignty that we might say is desirable or might not. And third, we can say, well, there's such a thing as democratic policies, which means that the people of a certain political entity have a say, and the majority of them will have a say and make their voices heard and their interests articulated. And Rodrik argued here also we can only achieve two of the three. He says in the Bretton Woods system we achieved a nation state because it was mainly based on national economies being sovereign actors in economic policy, and it was also focused on a version of democracy where the interests of the majority of the population could be realized, and this is the Bretton Woods Compromise. However, it had to sacrifice deep economic integration to some degree. Then he says under the Washington Consensus we moved on to what he calls the golden straitjacket, which means of course it's golden because it's economically good supposedly. However, it's a straitjacket because it doesn't allow democratic policies. We still have nation states as the primary actors. However, national economies are integrated, and this means that the economic choices that individual governments have are rather limited. And the third alternative would be to give up the nation state as the basis of politics and try to realize democracy on a global range, and then we have politics that can control and balance the consequences and dynamics of a globalized economy or of deep economic integration, and this is what he says could be global federalism. However, the question is, can this even exist? Will this exist? And can those beginnings of global governance that we see really point in that direction, and will there ever be such a thing? Or does deep economic integration de facto always mean that we don't have democracy? This is the question that Rodrik points at here. Now we come to the final part, discussing the international financial system or financial markets. And finance generally means that it has something to do with the exchange of money and currency. So Susan Strange defines a financial structure as the sum of all the arrangements governing the availability of credit plus all the factors determining the terms on which currencies are exchanged for one another. So all this is the financial structure, and there always has to be some kind of financial structure in a global economy. And we can at first glance distinguish two kinds of markets that are relevant here. So on the one hand, we have capital markets, and capital markets are about financing investment. So this is a rather long-term approach, of course, because investment always means that you put money somewhere where you hope that more will come from it. For example, we often talked about companies investing, but you can also say that you as an individual or as a household invest. If, for example, you decide that you don't want to pay rent anymore and instead you invest in buying a house or buying an apartment, then this could also be termed an investment, because you hope that this will pay off over the years, because it will save you paying the rent. And capital markets are the markets where you could finance these kinds of investments, which basically means that you could find creditors who give you credit for it. Money markets are more concerned with providing short-term liquidity, mainly for commercial banks. So liquidity means that you have money and assets at hand that you can quickly exchange. If you want to buy or sell stuff, then you need liquid assets. Then a house won't do you good. A house is not very liquid. Money in cash is very liquid, and also government bonds are typically considered quite liquid because they will be accepted widely, at least if they are government bonds from Germany or the United States, and not always those from Greece. If we differentiate this a little bit further, we can distinguish 5 kinds of financial markets. And I discussed them here by first describing what they do, and then I described what their purpose would be if you accept the idea of you, or if you think about capitalism in the way that you say, well, we want capitalism as a productive system that generates mass welfare for everyone, then we need certain subsystems that have this and this function, and then you can say, well, this kind of market is good for this whole concept because it fulfills this function. And in the end, I will discuss the risk that comes with it when it comes to speculation. And when I talk about speculation, I don't mean this morally. I don't want to say that anyone who engages in speculation is an evil person or so. It's only that if their speculation means it is a form of interaction and a form of using money that is based on some sort of a bet or expectation that the things that you buy will go up in value, and that's not productive investment as the thing as buying a house or giving a company capital in order to invest in production facilities or so. So I'm not saying that people who do this are bad and greedy people or so. It's only you can say, well, does it really fulfill a function for capitalism that will make it produce more wealth for everyone? So if you look at credit markets, those are the markets where banks serve as intermediaries between people who save money and people who need credit. So, for example, a bank will accept saving accounts from a lot of households, and then this way gather millions and millions of dollars, and then they sit on these millions of dollars, and then they want to put that somewhere and maybe buy bonds from the state, or maybe give a credit to some other household that wants to buy a house. So here banks are the intermediaries, and these are markets because, of course, the banks will compete for customers with different offers, and it's the way it's organized in a way that it is a market. And this, once again, is an important market without which capital could not work in the first place, because capital needs to raise credits and needs to raise investments. And on the other hand, there has to be some opportunities for savers to put their money, and the banks act as intermediates here. And there is, of course, some risk of speculation, because parts of the global financial crisis of 2008, 2009 also stemmed from these kinds of businesses, so from home loans in particular. However, if this kind of activity was regulated, you could say, well, there's not the highest danger of speculation here. Then the next part is what we refer to as the securities market, in the sense of the primary market. Securities mainly means papers that have the guarantee on it that they will be worth some money, basically. So these are, for example, bonds from government, where the government says, well, you lend me 1,000 euros, and this piece of paper certifies that I will pay my debt, because I will always pay my debt. So this is a security, or it's also a security if there is a stock, which means, okay, this is a part of a company and it's worth such and such percentage of the corporation, and this is also a security. So these are papers that are worth something, is what we refer to as securities. And the primary market means we're looking at the market where these papers are originally issued. So we have corporations that issue stocks for the very first time, or issue a second bundle of stocks that was not traded before, but now they issue it, which is called the IPO, or initial public offering. And then they sell this to traders who can buy these stocks. Similar, the governments will say, well, we need new fresh money to pay for the policies to overcome the coronavirus crisis. So we issue new bonds, and then they will issue that, and then certified traders can buy these bonds once they're issued. And once again, these markets provide possibilities for companies and also for others to raise capital for their investment, and it also grants opportunities for savers. And once again, there is little risk for speculation if this is somewhat regulated, and not everyone can issue bonds and stocks as they will. Then we have the secondary market, and typically, if you think about the stock market, what you think about is typically the secondary markets, where stocks that were issued at some time in the past are then traded. So if you look at all those tables in the newspaper or those charts that you see, then this typically refers to the secondary market, where bonds and stocks that were issued months or years or decades ago are still traded between traders, and then raise or decrease in value. And this also fulfills an important function, because it ensures that the liquidity, that the assets sold on the primary market remain liquid. Because just think, anyone who would buy a bond from a government or a stock from a company would then have to keep this bond or stock indefinitely. Then probably a few people would really engage in this, because there might always come a time in your life, or in a life of a company, if you want to call it life, where they need to be liquid. So let's say you invest a majority of your savings in stocks, and then your car breaks down and you say, well, I didn't expect this, but now I need 10,000 euros in order to buy me a new car. Then you might want to sell some of the stocks, and this only is possible if there's a secondary market. In addition to that, those secondary markets are also supposed to generate information and communicate information on how well these companies are doing, because the general idea of the market is that the market forces will always make sure that stocks where the companies perform well increase, and those who don't perform so well decrease. And this is also the idea that these markets generate information. And on secondary markets, of course, there is a certain risk of speculation, that maybe someone will not buy the stocks of the company in order to have it for a couple of years and then earn on the dividends paid on the stock, but rather because they hope that next week the stock will go up, and then they will initially sell it. And these kinds of dynamics can feed into blowing up bubbles, and that's also part of the stock market. However, there can also be some regulations for that. The next point is what's called the foreign exchange market, and it's also discussed at length in the textbook. So this is the market where currencies are traded, where those who are active in the markets, I'm not going to say you because it's totally not you, but those who are hopefully not you, those who are active in the markets can buy dollars for euros and buy yen for dollars, and so on and so on. And this kind of market would not be important under a system such as the Bretton Woods system, but under a system with floating exchange rates, it becomes very important. There always has to be such a market, because somehow importers or exporters have to be able to change their money, or investors. However, it only becomes an object of speculation and interest itself if exchange rates float. If they are always the same, then you cannot make money from it. If they fluctuate, however, then you can make money from it. And this is, of course, prone to some speculative businesses, which can also be problematic. It's described in the textbook. It can even take the form that a couple of investors attack a certain currency because they kind of think, well, this country is economically not very stable, and so they sell all all they have from this currency, or maybe they even make some other businesses where they say, well, I'm sure that this currency will go down, and this can be some type of self-fulfilling prophecy if enough investors do this, and if strong enough investors do this, and this can be quite risky. And here you can argue, well, these kinds of trades, will they ever do any good for the production of welfare in society? And you probably have a hard time to argue this case that these kinds of currency speculation really help fostering production anywhere. It's important that some trade is possible there. However, if there is a lot of energy put into currency trading, it means that maybe some very talented people spend all their time and energy in currency trade. Nothing much good comes out of it. the only thing that good comes out of it is good for these traders who might earn a lot of money there, and their banks or their organizations earn a lot of money there. And you can ask, so why should they have all this money if nothing good in the sense of a production of wealth come out of it? Because it's always a zero-sum game on these markets. So every dollar that's made is lost somewhere, as opposed to production or service sector. So here you can ask, well, do we really need this to that extent, or can we slow it down a little bit, because we want some trade to happen there, but we don't want this kind of very high-speed speculation. And this is where the Tobin tax, for example, comes into play as one way to try to decelerate these kinds of trades. And finally, you have the derivative markets or the future markets, and this is, you can also differentiate this out much further. And what happens here is that there are financial products that are derivative of other financial products that are then repackaged and rebranded and then are traded once again. So one of the things that happened in the global financial crisis in 2008 was exactly some kind of trade with derivatives that got out of control. First of all, this seems to make perfect sense, and there is some merit to it. So for example, just think there is a small bank in some rural area somewhere that gives out house loans, and they give out house loans to 100 people in the area, and they say, well, we get a certain amount of interest for it, and there is some risk that some of these people will default on the loan, but in general we're very confident that we're going to make a profit after all. And it might be that their calculations are good. However, if you only have 100 homes in a small area, it might very well be that this area is hit by some problem. So it might be that a big factory in this area closes, or that there will be some kind of natural disaster with all the houses destroyed, or something else happening in this area. Maybe it's at the coastal area, and now all the people think, well, living on the coast is not a good idea in face of climate change. So then the calculations of the bank will turn out to be faulty in the long run, because more than just a few people default on their loans. So then the bank has a problem. And one way to deal with this is to bundle all kinds of housing credits from different areas, and then cut them into slices and bundle them differently, so that the risk gets dispersed, and then you slice it again and rebundle it again, and it gets dispersed even further. And this works a little bit like an insurance, where risks are dispersed and risks are limited, and this is to some extent a good thing for credit markets to work. However, it also came with the problem that those people that actually sold the house loans were not the same people that in the end had to live with the risks, and those people who had to live with the risks didn't know that much about the risks they lived with anymore. And it probably would still have worked if we would have been in a situation where only very small events in small areas would have caused people to default on their debt there. However, we then had a systemic problem in much of the United States, where many people defaulted on their loans, and then this whole calculation of dispersing risks meant that almost all banks, not in the United States only, but also in Europe, in parts of the rest of the world, had these toxic assets, and many house owners defaulted on their debt. And then we had a crisis, and nobody really knew which banks had how much of these assets, and the banks themselves didn't know. So then banks became very hesitant to give money to one another, and so the interbanking business broke down. And then we had a full-on banking crisis where hardly anyone could get credit, and then the whole thing spun out of control. And these kind of things also can happen. So to some extent, these kinds of markets fulfill a function. However, they were well beyond the point where they fulfilled a function for generating wealth, and only generated wealth for very few people for a very short time, and generated a lot of risk over time. And what we see if we look at the development of the last 50 years or so is a development that we might call financialization. And financialization refers to a development under which you could very, very roughly say that we move ever further to the right on this graph. So the more complex and more speculative businesses become more important, but in general you can say that all of these markets grow in importance, so the financial sector becomes more and more important to the overall economy. The term financialization, as a definition, refers to a transformation of capitalism in which the relevance of the financial sector grows, and the dollar Wall Street consensus, or dollar Wall Street regime or Washington consensus, unleashed a real dynamic of this financialization. What does this mean? It means that financial markets become central institutions of the economy, and they are the most globalized sector of the economy. So we have trade, which is kind of globalized, we have investment, which is kind of globalized, we have labor movements over the globe, and all these things happen. But the one thing that is the most globalized, where streams across country borders are the most frequent and the biggest, is in the financial sector. And financialization also means that we have what we call financial innovation, which means ever new financial products are created, sometimes with merits, but sometimes just to have something new to trade. And what financialization also brings with, when we look at corporate government, so the way in which corporations are managed and led, this led to the emergence of what we call shareholder value orientation or shareholder value capitalism, in which the top managers of a company will always make the decisions that they believe will lead to the stock prices of their company to rise and to make the markets happy. And this means making other decisions than, for example, if you say, well, let's make our employees happy or let's make ourselves happy. So there is a shift in corporate governance there. And there are people who would argue that this financialization is a good thing. So what it definitely means is that you have a high availability of credit and liquidity, and if you look at it from the other way around, there are more chances of investment. So if you have money and you want to invest it, there are more chances and more interesting chances maybe to do it right now than there would have been 60 years ago. And if you believe in the market forces, then you also say that a more rational allocation of resources is made possible by financialization, because the market always knows best. And if companies engage in shareholder value orientation, it means that the market will always look at what's most profitable for the company, and then the company will do exactly this to please the markets. And so the most effective business practices will win. And this is the very positive view of this. There's also a more negative view of financialization. Some argue that this is very much prone to speculation, and that it brings about what Susan Strange called casino capitalism, which then is supposedly detached from the real economy. I would always take this term casino capitalism and this detachment with a grain of salt, meaning that this is a representation of processes that happen, but it's an exaggeration, because it always has still something to do with production. There's still a certain attachment to it, and also the casino part might not give the best presentation. However, if you look at the way that some investors look at this, it might not be the wrongest way to describe it. And financialization also means that there is a high chance of financial crisis, even unforeseen financial crisis, because not that many people foresaw what happened in 2008, and this can then also spill over to the so-called real economy, means to the sectors of production and to non-financial services. It also means that the financial actors become more and more powerful, and these are of course actors that have no democratic legitimacy whatsoever, and that are also even less controlled by democratic actors or unions compared to normal businesses or companies. And it can finally also even mean that governments might be dependent on financial actors, and this is also something that was widely discussed in the Eurozone crisis. And there is this one expression that Angela Merkel termed, where she said, yeah, of course we want democracy, but we want a kind of democracy that is compliant with the market. So some kind of market compliant democracy, which is not the way that political theorists or the writers of constitutions typically think of as democracy. I'm not going to bombard you with numbers, but I come to an end right now. So just one very brief expression in terms of numbers. What you see here in the first line is the total sum of global financial assets, so the total value of all stocks and bonds and other kinds of securities that are out there. And you see these here measured in trillion US dollars, and there was a total sum of 12 trillion dollars worth of global financial assets in 1980, and then you see that these numbers exploded until 2007, when it has increased, I think it's probably 15-fold, 16-fold to 196. Below that you see the global GDP, which is the total annual economic output, so the worth of all products and services that are produced worldwide. And these have also increased over these roughly 30 years, but only 5-fold. So the ratio between the two has increased from 1.2 to 3.6, which means that the ratio has increased 3-fold. And if you now think, well, how can it be that the financial assets are worth more than the global GDP? This is not some buffoonery, and it actually makes sense if you think about it for a second longer, because the global GDP just means the output in 1 year, and the financial asset is the worth of something that's there. And if you think of an individual company, this will typically be worth more than what they have as an output per year. However, this change of relation here is still impressive, and it means that financialization was progressing. And just a brief update on what happened in the last 13 years is that the growth in global financial assets was slowed down a little bit, so it didn't grow at the same rate as it did before the crisis. However, the same is also true for the global GDP, which also still grew, but it grew not quite as fast as it did before. So the ratio even increased between global financial assets and the GDP. And if you think about this financialization this way, this leads us maybe back to Rodrik's trilemma, where you can ask the question, okay, where is the democratic politics here, and how good is this for democratic politics? And this is the question I want to leave you with today. Goodbye, see you next week.